What's going on, everybody? It is Wednesday, April 30th, end of the month. I just got back from my Wednesday night sparring session. And I got to tell you something just briefly, and I've said this before, I think motivation is very overrated. There's only very few instances where motivation, I think, can affect behavior or action. And that's really, I think fear is the primary motivator. If there's a threat against you, physical threat or something else very serious, you're motivated. Other than that, I think when people talk about motivation and motivational speakers, I just think that's a bunch of BS. I think the most important thing, and I've said this before and I'll say it again, and maybe you come here to hear me talk about economics, and I get it, and I'm going to get into that, but I have to say that the most important thing is discipline, is just doing what you got to do. And the only reason I bring this up is because every time I go sparring, I go Wednesday night and Friday night, I am not motivated to go there at all. I don't want to go. There's resistance. I feel resistance within me to go. Anxiety. I got to get in there in the ring. I'm 68 years old. I got to fight, guys much younger than me. But I just do it. And, the funny thing is, I go to the club, and when I get there, I'm literally thinking, let me think of an excuse where I got to leave. I am. I'll be honest. I'm literally thinking in my head, oh, I don't see anybody to spar with. Of course, there's somebody there always that I could spar with. I'm thinking, I don't see my usual guy, or this hurts or that hurts. Let me just go. And I don't allow myself to do it. I have those thoughts, and it's almost like I have this separate entity, this sidekick Mike Norman, invisible, who pushes me in there and makes me do it. And then once I do it, it's fantastic. But that's what it boils down to. It's just the discipline. And by the way, it's not boxing. It's every day, waking up at 4 o'clock in the morning, going to the gym, whatever you got to do. I'm sure you understand what I'm talking about. Anyway, today was a weird day. Not weird, but we got some economic data early, and that was advanced GDP for first quarter. Of course, the forecasts were for a negative first quarter, and I'm going to explain that, but we had some of the forecasts were as bad as negative 3.5% or 2.5%. I think that the Atlanta Fed had 2.5%. It was 0.3%, which is not that bad, actually. Now, the breakdown, the whole thing came from a record increase in the trade deficit. Net exports, which is always a subtraction from GDP, because the United States runs trade deficits and current account deficits. The net exports had the biggest subtraction ever. It was minus 320 billion or something like that. I went back through all the years of the data from the Bureau of Economic Analysis. That is by far, without question, light years ahead of even the second largest subtraction that we've ever had. So what that was, and you probably know, that was firms and consumers front running the tariffs. They knew the tariffs were going to hit, so everybody, stock up while you can before it gets hit with the tariffs. So that's what that was. So most likely that's a one-time thing, okay? Again, we only had a minus 0.3% subtraction. Of course, that's going to be revised. This was the advanced number. All right, so that's number one. Number two, in that report, we got a very nice increase in non-residential fixed investment, private business investment. That was up the most since the first quarter of 2022. Non-residential fixed investment. And we want to see that because that is the goal of the tariffs, right? I mean, like, make the stuff here. So that happened in the first quarter. Now, I expect that to go up, to continue to go up in a larger magnitude. Again, it was up the most since the first quarter of 2022, and that offset some of that massive trade deficit that we saw. And I think maybe a lot of that trade deficit was, if I'm not mistaken, and I remember reading articles about this, like everybody jumped in to import gold and silver, like it was because they didn't want to pay tariffs on gold and silver, whatever. So that's basically the breakdown of what happened. We got that negative print. All right, we got the PCE deflator, the personal consumption expenditures index, which supposedly they always say like that's the Fed's favorite indicator. I don't know. It sounds like another one of these kind of silly, expressions or things that they come up with. But on a month-over-month basis, that thing was flat. On a year-over-year basis, the core was up 3.5%. That was higher than the forecast, which was like up 3.3%, and it was higher than the last reading, which was up 2.6%. So that put a little, I would say, a tiny little bit of negativity into the bond market, but the two-year yield was lower, the 10-year yield was flat, and the 30-year yield was up a little bit. All right. But anyway, I sent out, when the market was down, it was down like 600-700 points. The Dow was down like 600-700 points after the opening. And I sent out an email to my subscribers. I said, look, we're into deep support, strong support here. We're going to rally back. And sure enough, that's what happened. And we had a pop right at the end before the close, which the markets closed positive. We are still in this scenario, I think, that the picture is kind of unclear still because we still have to get the budget. Leading flows are very, very strong, but we have seen a slight reduction in net government transfers. Okay. Tomorrow is a tax day, a tax drain. By the way, we had check this out. 13 of the last 14 statement days in April have been drains. And the drains now amount to 422 billion, something like that. 422 billion. So it's been big, man. And the government is running a surplus right now for April of like 321 billion or something like that. And I said this the other day, once that becomes public knowledge, like the media always catches on to this like weeks after I tell you guys, because again, I see this every single day on the daily treasury statement. That's why I keep saying, if you got to be with me in terms of, because I'm giving you all this stuff ahead of time, before it's released in the data. I tell you in advance what's going to happen. So like nobody else does this. Nobody else does this. So what I said was that as soon as that it gets sent out or it gets released that, hey, the government ran this huge surplus in April, Elon Musk is going to raise his hand and say, you see, that was Doge. Meanwhile, spending is just going up, 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 up. There's been no cutback in spending. The other thing I want to mention is that I am seeing significant tax collections on the tariffs. Okay, remember, that is a transfer from the non-government to the government. we lose one way or another. That's money going into the government's pockets. That's dollars going to the government and away from the non-government. All right. That's going up very, very significantly. So that is going to become more and more of a negative factor. Right now, we're just at the very beginnings of that. The other thing, which I've been telling you guys about, is interest income transfers. T-bill interest income transfers are down 25 billion. That was as of last Thursday, the 24th. You know, I update this every week. I could update this every day if I wanted to, but on interest income transfers, I do it weekly. And that seems to be starting to drag down overall interest income transfers. Don't forget, we have a quarterly interest payment coming up on May 15th. So what's going to happen is that we still have very strong leading flows. This is like adding buoyancy to the market. You know, to go back to it seems like I've been using a lot of these nautical boat analogies recently, the bilge pump and this and that. It's going to add buoyancy, but there's sellers at higher levels. Every time we get a rally here, you've got leveraged funds that are selling. And now what I am seeing is institutional asset managers just kind of in a fixed liquidation. In other words, they're liquidating. I could see their futures positions in the S&P. It's just trending down, down, down. And I said, you know, way back when it was like 1 million, they were over 1 million net long. I said, that's very, very high. And that is the potential for liquidation. And then I said, we got to at least see them come down to, let's say, like 725,000 net long in the futures. They're nowhere near that. They're still over 800,000. And really, like when we saw the bottom in COVID, that institutional asset manager net long position in S&P futures was like 200,000. Now, I don't think it's going to get that low, but I think in order to be comfortable to call a bottom, I think it's got to, and that, you know, that's just one element. That's just one factor. Because if we go in a recession, the only thing that you need to look at, once you go in a recession, then there's only one thing to focus on. And that is what is happening with the automatic stabilizers, which means unemployment benefits, Social Security, Medicare, Medicaid, these things that kick in, food stamps, these things that kick in when you have an economic contraction, and they really start to add net transfers. That's what you look at when people say, well, Mike, how do you know when a recession bottoms? I know because I look at that, and when I start to see those things really trending higher, you know, that's the fiscal pump really getting into action. But like, we're nowhere near that scenario right now, you know? So, like I said, a lot of things still have to be determined. And like the biggest thing for me right now is the budget. Like, what are they going to come up with? Are they going to come up with net spending cuts? Are they going to come up with net spending increases? And, you know, there's still there's unknown factor of price increases. I spoke about this yesterday, and how the Fed may react to that. Well, we probably know. I mean, if inflation starts picking up, by the way, I don't see any evidence of that in commodity markets. I mean, you got oil at $58. You got commodities going down. You got gold, you know, looking like it's topping out here. I mean, this might be a temporary pause. I'm actually bullish on oil. Every time it gets down here, I buy. we're supposed to have a very active hurricane season. So oil and natural gas, I think coming into that season, we're going to see prices shoot up again. And then that's when I'll probably take my profit. But so I don't see it in commodity markets. You know, like I said the other day, because of all this inventory build prior to the tariffs, you know, firms stocking up on goods before the tariffs hit, it gives a little, like a little reprieve, a little break before the price increases, if there's going to be any. And I figure we'll first start to see it in the June, once June comes around and they start releasing the data, you know. But I'm not so sure. I'm just not so sure. But right now, I'm buying the dips and, you know, on these rallies, taking some profits because we're just seeing liquidation. I like treasuries, as I've been saying. I like treasuries, so I'm sticking with that trade. That's it for today, folks. Hope you had a great day. Please like and subscribe. And don't forget to go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. I'm the only one who does this. MMT applied to investing and trading. And see you tomorrow. Bye.